Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade. But first, the required disclaimer material. Please be aware that this presentation is given for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that the risk in trading options is substantial, and please make sure you are aware of all your risks prior to placing any trades. Also note that in this presentation, we are using hypothetical computer-simulated trades and or results. They're believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. If this is your first experience with us, my name is John Locke, and I'm a trading performance, wealth, and success coach with Locke in Your Success LLC, where myself and my team of mentors are here to help you win in the markets and in life as well. And today, I'm here to take you into the realm of high probability options trading. Now, high probability or options trading, or income trading as it's also known as, is where we utilize option strategies to make money from the passage of time rather than depending on price movement alone. Now, what this means is that we can often make money whether the market goes up, down, or sideways. Now, this doesn't mean we're going to make money all the time, but it does mean that we're much more likely to make money, or we have a much higher probability of making money than we would if we were purely directional trading. So the income strategy that I would like to discuss with you today is called the V32. Now the V32 is a shorter term market neutral broken wing butterfly strategy that we trade on the Russell 2000. It's actually a bit bullish bias. However, it is going to maximize this performance in upward trending marketplaces. Now the V32, if you were to trade it at its minimum size, requires a minimum capital of $3,500. The example size that we're going to deal with today is what we call a 10 lot, so it's 10 times our minimum size, and that is going to be a planned capital of $35,000. The profit target on this strategy is none. We actually don't have a profit target. Generally, if we have a winning trade, we expect to win somewhere around 10% or so. Sometimes we can make 20%, 30% on this strategy, so it does have the potential to have some very high returns. And our exit loss trigger is going to be 7.1% of our planned capital, or in this case, $2,500. So this is what the V32 looks like on entry. Now, for those of you who are new, you may not understand what the heck you're looking at. This is an analytical software called OptionNet Explorer. And what this software does is it shows you the risk in your positions with price movement and the passage of time. So over here on the left side, we have the asset that we're trading. We're trading the Russell. The current Russell price is $22.39.63. That's as of April 21st, which is a Wednesday. And let me shift us back to 15:30, or our entry time here. Now 15:30 is 3:30 Eastern. On these strategies, what I do, by the way, is we enter these what we call non-subjectively. So we're not looking at pricing, we're not looking at news, we're not chasing and figuring out what implied volatility is doing. We're simply watching the calendar. And when our asset is 30 days to expiration, or our option cycle is 30 days to expiration, we are going to start the trade. Now, all the demonstrations we do are in the monthlies, but you can do these in the weeklies just as easily. It doesn't really matter. So what this software is telling us is we're looking at an expiration cycle for May 2021. We are 30 days to expiration. On the top is the calls, on the bottom is the puts. Of course, we have our strike levels here down along the sides. If we take a look at this, with our position, what we're going to do is we're going to do what's a formation called a broken wing butterfly. So what a broken wing butterfly is it's two vertical spreads, if you know what those are, and they kind of face each other, and you'll see that in the analytical graph, and they have different sizes. So here we have short strikes, or we're selling our 2220s. Why are we selling the 2220s? We're selling the 2220s because, according to the rules of the strategy, we are going 17 to 27 points under the market for our short strikes, and the market price right now, or the Russell price, is 22.37. That puts us at 22.20. So we're going to sell 20 of the 2220s, and then what we're going to do is we're going to buy 10 of the 2160s. That's 60 points underneath our 2220, so it's what we call a 60-point wing. And then we're going to buy some 2260s, which are 40 points over our short strikes, and that's called a 40-point wing. And this creates what we call a broken wing butterfly structure. Now, if we come over to our analytical part of the graph here, we have the asset price along the bottom. That's different than your standard price chart that has the prices up the side. All right, on our analytical chart, our prices along the bottom. Now this shows us essentially three things. It shows us our profit and loss with price movement, and it shows us how things are going to change over time. So when I look at this, you see the triangular shaped line, or the sharp edged line, the blue, dark blue line here. And this is what we call the expiration graph. And what this tells us is the value of this position at any asset price at expiration, or in the future, 30 days in the future to be exact. The other line we have here is called a T+0 line. This shows us our estimated value or our projected value of this position at any given price point as of today. And it's called the T+0 line, or today plus 0. And you can see right here there's also a red dot, which is the current asset price and my current profit and loss. Over time, what's expected to happen is this T+0 line moves towards our expiration line, and therefore if the price didn't move and only time passed, for example, then at expiration this position would be worth almost $25,000, or would have gained almost $25,000 in profits. Also, if we come back down here, you can see our total risk in the position at this point is only about $18,000. And if the asset price were to come down here and stay here until expiration and we did nothing, then we would lose, what, about $17,000 or so. The trick is we're not going to do nothing. We're going to do some adjustments. So this is our initial position when we enter. We're currently at what we call a delta of positive 28.31. This delta number represents our price movement risk in our position. So what it means if you're a positive 28.31 is if the asset price moves up $1, so from 23.3751 to 23.3851, then it's estimated or projected that this position will gain $28.31. We also have a number called theta that we pay attention to, and theta is our estimated gain or loss in our position over time. Now, if you buy stock, you would have 0 theta, because if a stock is $100 and it stays $100 for the next 3 years, you don't gain or lose any money. It's different in an options position. In this case here, we're positive 89.85 theta, which essentially means that tomorrow, if nothing else changes, this position is expected to be to gain in value $89.85 in profit and loss. If I buy a single option, then I'm usually negative theta. If I sell options, I'm usually positive theta. So our game here is to watch our theta number, watch our delta numbers, and see if we can make money through the passage of time and control our price movement risk along the way. So with this here, we have what we call adjustments. And the adjustments that we make to this strategy is if the market or the Russell price drops below our short strikes, which in this case are 22.20, if the asset price drops below 22.20 at our checkpoint time, this is not one of those strategies you have to watch all the time. It's one of those strategies that we just come in once a day, we take a look at it, and if one of our parameters are breached, we adjust or exit the trade or whatever we need to do. So in this case here, our parameter is 22.20. If the asset price is under that level at checkpoint time, we will exit the position and roll it back. So we're going to essentially take this off and move it. If the asset price goes up and we get to the point where this T+0 line turns negative on our delta number, we're going to adjust this position, and we're going to adjust that by taking our 2260s down to 2250. Now, once we adjust this, there are different rules for adjustments to the downside, and we're not going to be able to cover all of those in this short video demonstration, but we'll do the best we can as the situation comes up. So this is our entry position here. I'm just going to go to the first adjustment. So it's April 21st, And what we do here is we do nothing until May 11th. So April 21st to May 11th is what, about 20 days? Over those 20 days, the market had moved around and so forth. But now, actually, if we look at our price chart, we can see. Okay, so over this time period, the asset price actually dropped quite a bit. And now it dropped even more. Now, remember I said that this was a bullish bias strategy? And it is. But the great thing about this strategy, unlike a directional strategy, right? A directional strategy, it moves down a certain amount, you get stopped out, and a lot of times the amount it moves down is very little. In this type of position, we can get a very large move to the downside and still usually work out okay. So that's what happened in this case. Remember, we started with our asset price up here at, let's see, it was at about almost 22.40. The price dropped all the way down at 22.06. And the position's actually up $1,760. Pretty cool. So we're here, but we are past what we call an adjustment point. Remember, we said that if the asset price drops under 22.20, and it's now 22.06, we're going to roll it back. And roll it back consists of removing this position and repositioning it down at our new entry point, which is actually going to be, remember, 17 is 27 points under the money. That's going to be 21.80. So let's take a look at this. So we come back down to 21.80. We do our 60-point wing on the bottom. We sell our 21.80s. We buy our 21.20s. Then we do our 22.20s here up at for our upper long strikes. Now, when we do this rollback, particularly if we get close to expiration, we're not always able to go into a 60-40 broken wing butterfly, in which case we change the parameters of the wings, and that's within the general rule set of the strategy. But let's go to our next adjustment point. So it's Tuesday, May 11th, 2021, and next adjustment happens the very next day. So this is what happens. We get a 69-point down move following our other down move. Now, being bullish bias in the strategies may be hurting us a little bit because the price movement is just too fast. But let's look at the price chart. We started up here in a bullish bias strategy. We had to adjust back here, and now we got another really big down move to the downside. And it took away our profits, but we're still within our loss tolerance. Remember, our loss tolerance is $2,500 with a down move. And this is perfectly fine, but we are going to want to reset this. So we're at 27.31. We're going to want to move this position back to, let's see, 21.20. That's 100 points down from our starting position, right? I'm going to want to move it down here. So there's our 21.20 shorts, 60-point wing to the downside at 2,060, 40-point wing to the upside at 21.60. This is our new position here. Now, one of the things I love about this strategy is by maintaining our positive delta bias in the strategy, it recovers really well if you get these market conditions where we get these really big down moves. Assuming you survive the down move, we get these really big down moves like this one, and then we get a really fast reversal or a V reversal to the upside. Typically, this strategy does pretty well. So let's see what happens here. We'll go to, it's May 12th, and we'll just go day by day here. On the 13th, we get a big up move. We get a nice shift in our T+0 line here. It comes up above. You notice the rise in the T+0 line. And we're now up $950 in the position. We're still positive delta, so we do nothing. We go to the following day on the 14th. What happens here is the position's up $1,300, and we've turned negative delta. So if you look at our delta number, it's minus 1875. So what we're going to do is we're going to take these upper long strikes and we're going to bring them down. In the process, when we do that, we oftentimes, depending on how our front wing is positioned, we're also going to take some risk out of the position by moving these 2060s up to 2070. So in this case here, what we did is we moved them both. All right, so let me shut this off again. I'll put this here so it's more clear. And this is our position change and our up adjustment. So it doesn't affect our total downside risk, really. And now we're, once again, positive on the delta. We're going from minus 1875 in this case to positive 1. And this is our new position here. And we're now 7 days to expiration, by the way. So let's move to Monday. Notice that from Friday to Monday that we are now minus 10 delta. So we're going to make an adjustment and we're going to do the same process. You can see we took the 2150s and they're now 2140. We have the 2170s that are now 2180. This is our new position. We're now positive 8 delta in this case. And let's move on. We're 4 days to expiration. Let's go into Tuesday. If we do that, we trigger our negative delta trigger once again, and we make another adjustment. This time it's not going to be quite as severe, I don't think. Right, so we're still moving the 2080s to 2090, and we're going to take 5 2140s to 2130, so it's a little bit less of an adjustment. Brings us positive delta to positive 1.95, and this is our new position here. Then we get a substantial down move. Okay, we're 22 points down. Nothing changes though. There's no downside adjustments triggered. Everything looks good. We're up $1,852. And then this Thursday here happens to be our last trading day on the asset. So we had a 16-point up move. This is a bad number, by the way. You can see from the scatter plot chart, but it doesn't really matter. This is the last trading day of the position. I can either choose to exit the position, and if I exited it, it would be at a profit of about, let's see if we can get a good number here. We would exit it here at about $2,000 profit. But what we're actually going to do with this position is we're just going to let it expire. And if we let it expire, it's going to expire right here at just under $2,000. And then, of course, when we're out of this trade, it's time to enter our next trade, and we go into the V32 for the following month, or in this case, the month of June. And that is how the V32 strategy works. I love the V32 strategy. It's what we call a stage 3 strategy within our Trader Success Blueprint. It's meant for intermediate market neutral income traders, and it's a fantastic learning tool and a fantastic strategy to learn for yourself and apply to the marketplace. And while I have your attention, I'd love to tell you about an opportunity that's coming up on June 30th. That's Wednesday, June 30th. For those traders who would love to make a business or a full-time career out of trading, or those who would like to supplement their retirement income through trading. And that webinar is called The 3 Essentials to Creating a Successful Trading Business. It's going to be a fantastic free presentation for the public. And if you ever considered going out full-time trading, or like I said, retiring from your job, and you want some supplemental income through retirement, through trading, then this is a fantastic opportunity to see what that's all about. In the meantime, I invite you to visit lockinyoursuccess.com. That's LOCKE in yoursuccess.com. And discover how you too can follow along with the V32 and many other great trading strategies as they unfold during our weekly Options Trading for Income webinars. Also, you can visit thewinningtrade.com, that's thewinningtrade.com, where you can learn about upcoming winning trade presentations, explore past winning trade presentations, and receive access to free bonus material, as well as our free Trading Success Blueprint. And perhaps best of all, you can come over and check out our free Trading Performance podcast, where you can learn to skyrocket your trading results regardless of the type of trading you do. If you have any questions, comments, or anything else you'd like to see in the next winning trade, please post that in the comments below, and I'll answer your questions and comments for you personally. Thank you for joining me, and I look forward to seeing you on the next winning trade.